As Richard mentioned, I'm going to give you a relatively brief overview on our outlook for 2017 for the CEE markets. We look at the investment flows that we've seen over the past few years into Central and Eastern Europe. We are, as we can see on the chart, the left-hand side chart of this first slide, the dark blue line is the investment into the region. The light blue line, unfortunately, is the investment that we are seeing into Europe as a whole. So all of Western Europe, including the UK. The bad news, and I'm starting off with the most bearish slide, the bad news, is that Western European investment is falling. We peaked in the first half of 2015 at 160 billion euros. We're now at 100 billion, it looks like, the estimate for the second half of 2016. So we're down about 30 to 40% in Europe altogether. Now this is led by Western Europe. The investment into the CEE 6, which is the dark blue line, and throughout this presentation that's defined as Poland, Hungary, Czech Republic, Slovakia, so the Visegrad 4, plus Romania and Bulgaria. Those 6 countries, the market share on the right-hand side chart is increasing. Our share of mind in Europe is increasing. We are becoming more important in Europe. It is our responsibility to keep this going. Can we withstand the downturn? So will this light blue line, as in the past has led the dark blue line, can we withstand the downturn that we're seeing in Western Europe at the moment? That's obviously pertinent, maybe for the panel to discuss, but also I'm attempting now to address what we think will happen in 2017. What we've got here is the most reliable leading indicator that I've been following for the last 20 years in capital markets. Is the light blue line on this chart is the German IFO expectation subcomponent leading indicator. This is a survey of 4,000 to 6,000 German companies that's done monthly. That is telling us really that economic sentiment in Western Europe, Germany in particular, which is obviously key for CEE countries, that sentiment is still pretty robust. What I've done on this chart is pushed it ahead in time 4 months and then put on it a composite sentiment indicator of the CEE 6 countries. So looking at the whole economies and what people are thinking, so a leading indicator for the Central and Eastern European countries. And you can see a pretty good relationship between those 2 lines. Now, this means that what this chart is essentially telling us is that Germany is in a pretty good condition at this point economically, and that therefore we should be relatively optimistic about the picture for Central and Eastern Europe in the short term. Now obviously if this German leading indicator turns down over the next year or 2, then there's a problem. But at this point, it's pointing upwards rather than downwards. So we can be, as I say, certainly for this year, relatively optimistic that the GDP growth, the economic momentum that we will see in Central and Eastern Europe should be quite robust because it's underpinned by the key German economy. What this means in terms of investment flow is that if one looks at the consumer sentiment in Central and Eastern Europe, so this is the light blue line on this chart, we're rising and we are continuing to rise. I've lagged this, pushed it out in time by 18 months again, so the dots on the right-hand side have actually happened already, and I've put it against the CEE investment flows, and you can see a good relationship between the 2. It's suggesting that CEE investment flows are likely to sustain. So this is again saying that the consumer is in particular obviously very important in the retail sector, demand, driving tenant revenues and pushing forward prospects in the retail sector in particular, but also obviously driving manufacturing, driving logistics demand in the industrial sector as well in particular, that these factors are all playing out in terms of the relative optimism of the consumer in Central and Eastern Europe, and that should help investment demand. And what we've seen is a manifestation of that in yields. So these are the latest yield figures that we are just publishing right now in the CEE 6 countries. So we've seen a lot of compression, particularly in Hungary, over the last 12 months. The ones I've circled are actually movements in the last quarter. So out of those 18 yields on this chart, that you've got compression even in the last quarter in 6 of those 18 yield numbers. So the compression is still ongoing. So there's still relative optimism in the immediate past, literally in the last 2-3 months. And our evidence locally here and also elsewhere is that this compression can continue for a little bit longer. And certainly that's the case in Southeast Europe. So Bucharest and Sofia in particular, you can see much higher yields. We think that there's still much more scope for those yields to fall as those markets liquefy, as they become bigger over the next year or two. So in terms of yield, it's indicating that we've got some room. How much room have we got? The big negative in 2017 for markets in general is that the rising bond yields that we're seeing around the world. And this started last summer, and it was actually, a lot of the news media is portraying it as a Trump issue, a Trump-caused issue. The election of Mr. Trump means fiscal stimulus in America, which means higher inflation, which means then higher bond yields. So on this chart here, end of October, the yield level in the US was 1.82%, and at the end of the year, it's 2.58%. That's a 76 basis point difference. So the world's risk-free rate, the US 10-year bond yield, has rose in 2 months 76 basis points. This has then meant that yields in other places, so Turkey, for example, I put on this chart, 98 basis point rise in yields. There's obviously specific issues in Turkey as well. But this is across emerging markets, this phenomenon. Now in Central and Eastern Europe, Poland's the most liquid. Poland's the most liquid bond market in Central and Eastern Europe, 53 basis point rise in the last 2 months of 2016, not as high as the US. And the other countries, some of them are euro-linked, the rise has been much less. But this process has started, and the question is, does this process accelerate or does it halt in 2017? This is the major risk in terms of then thinking about investment, thinking about the funding gaps and the prospects. Now, looking at these funding gaps, what we have on this chart is my attempt to look at the prime yield, so the blended prime yield in each of these 4 key countries of Poland, Hungary, Czech, and Romania, the blended prime yield in the marketplace, and then take off the 10-year bond yield, the local 10-year bond yield. So we can see then that what we have now relative to the past in all of these charts, they're all got the similar, very similar shape, is that we've got quite large premium, quite large funding gaps. So for example, in Poland, that funding gap is 2.2%. So the blended prime yield at this point, which is office, industrial, retail, is 2.2%, 220 basis points above the bond yield. Now that's at the average over the last 11 years has been 1.8%, 1.82%. So there's actually a premium to that average of 37 basis points. So there's some room for bond yields to rise in Poland, and all that will happen is simply the profitability of projects becomes lower. Now that might mean a marginal investment decision is not made, but that's at the margin. We have room, we have a lot more room in the Czech Republic, almost 500 basis points of the funding gap. Romania, 400 basis points. Hungary, nearly 400 basis points as well. So very, very large gaps. So the message is there is a lot of room for bond yields to rise. So this risk that's very evident in many emerging markets is less prevalent here in Central and Eastern Europe than in other places. Risks and opportunities in the rental arena. One of the drivers of those higher bond yields is higher inflation expectations. And in 2017, I've been an inflation bear for a number of years, but I've changed my mind over the last 6-9 months. I do think that we're going to see more significant inflation. So I put on the right-hand side chart the blended inflation rate of the 6 CEE countries. It's going to be 2.2% this year locally, but perhaps more importantly for everyone in this room, the Eurozone CPI. It could be north of 2%. It could be 2.5%. This is obviously the benchmark for rents in CEE markets. So that feeding through is actually arguably a positive. Certainly a positive for landlords, not necessarily for tenants. But those tenants are benefiting from economic growth. So particularly in the retail sector and arguably in the industrial and logistics sectors, they're benefiting from the economic growth, so they can absorb this cost increase. So that inflation is there, and it looks like, and certainly the 2018-2019 estimates are guesses at this point, but it looks like, Oxford Economics think these inflation figures are sustainable. What we've got then is that's an input into wage increases. And the other input into wages at this point is that unemployment in this region is very, very low. So if you look at this chart on the left-hand side, got Eurozone unemployment at 10%. Every single CEE country is below that level. Czech Republic, 4% unemployment. Poland, 5.7%. So very tight labour markets in the CEE region, and obviously within the countries, certain sub-regions within the countries have extremely low unemployment levels. So there's quite a significant pressure on wages. And this is a positive for the retail sector, because people have, if there's wage growth like we have in the Czech Republic of 5%, in Hungary the wage growth we estimate this year will be 12%, in Romania it will be 10%. We've got wage growth pressure across the region. We've seen this in Visegrad since 2005, so this chart showing the fact that wages have nearly doubled in the Visegrad region countries since 2005. Actually, this provides within the region an opportunity for Romania and Bulgaria, because their wage levels in absolute terms are lower. Romania's wage level is only 600 euros at this point a month in manufacturing, so much, much lower, and therefore we may see some substitution out of Visegrad floor in the industrial sector towards South and East Europe. So the wage issue is one which helps the retail sector, but doesn't help the industrial sector, manufacturing, and also doesn't help the BPO, SSC, business services within the office sector. Obviously, wage growth is not necessarily positive for that activity. Just touching on urbanisation, because I think it's going to be one of the themes that may be touched on later, and I've taken a specific look at some aspects in Poland. First of all, first observation is the overall urbanisation rate in Poland has not changed in the last 10 years. It's 60.5% in 2015, and it was more than that in 2005. So the overall urbanisation of Poland has not really changed over the last decade. What has happened within the country, on the left-hand side chart, is what I've got here is source from Eurostat. The population change in various Polish cities is quite marked, even in a relatively short period of 5 years. So the greater Poznan area, Poznanski, up 5.5%, Gdansk, Tri-City, up 5.3%, Warsaw up 3.5%. On the positive side, on the negative side, Łódź, minus 3.3, Łomża, minus 2.5. So there's other regions seen a significant reduction in population. So I think thinking about urbanisation and population change in Poland, we've got to bear in mind that there's these big dynamics going on. And then there's also the dynamic of the business services sector. And what's happening there is that we wrote a big report last year in conjunction with a PZ, and that report was looking at the centres outside of the top 8 cities in Poland and the employment that we're seeing in the business services sector. And we've got 3,000 employees in Rzeszów, Szczecin, Lublin, and other centres are growing very fast. So we're looking not just at the top eight agglomerations in Poland, but also the smaller cities as well. So it's quite interesting dynamics here in terms of thinking about urbanisation and population movements within Poland at this point. Coming back to the 2017 outlook, the main disruptor that we see to the more positive retail story that I've hinted is actually e-commerce. If you look at the UK, 81% of the population in the UK have shopped online, which is a very high proportion. I can tell you my 68-year-old mother uses an iPad and she shops online. So it's happening. It's happening. It's very clear it's happening. What we see in Central and Eastern Europe is that the percentages are much lower. So even Slovakia is at 50%, that's the highest in the region. And then Romania, Bulgaria on the right-hand side, only 18%, 11% in 2015. This is according to FactSet. Poland, they're at 37%, so roughly 1/3 of Poles shopped online in 2015. This is likely to grow quite fast. If Statista on the right-hand side suggesting that if one looks at growth rates in 2016, 2017, we're between 10 and 20% growth. That's growing twice, 2 to 3 times the level of retail sales growth in these economies. So the e-commerce market's kind of capturing market share. So your local Amazon equivalents in the region are capturing market share at the expense of the old high street. So in the UK in particular, I mean, you've got deserted high streets as Amazon takes over. Will this phenomenon happen in Central and Eastern Europe? Does this affect the retail sector? It's certainly a disruptor that we're watching very closely in terms of the outlook for the otherwise pretty buoyant retail sector at this stage. So then summing up, our outlook is generally positive. We think the glass is half full rather than half empty, and that we will see continued momentum in consumption-led GDP growth, that underpinned by Germany, but also by fiscal policy in the CEE countries. We've had very good budget performance in the CEE countries over the last 2 years, and they've had a lot of tax revenues because the economies are growing quite well, and therefore some of them are expanding their fiscal programs. So that also supports particularly demand and therefore rents in the retail sector. And as I mentioned, that wage growth is also positive for the retail sector in terms of generating demand, and it's a negative for the office sector and industrial when thinking particularly about BSS and manufacturing. The inflation spike is something more technical that will help landlords as we finally see some inflation. Specifically in the Czech Republic, we've made a call that we think the Czech crown is going to breach the one-way cap that it has against the euro even this quarter. So even in the first 10 days of 2017, we've seen almost 10 billion euros of intervention to keep the Czech crown down, which is a huge number. It's 5% of Czech GDP. So there's huge pressure at this point on that currency to appreciate. That has all sorts of consequences for the real estate sector, but principally Czechs will have greater purchasing power relative to the rest of the world when it happens. We're likely to see an appreciation of that currency. As I've mentioned, we don't think the effect of rate rises on the CEE real estate arena is going to be immediate. But that risk is there, and we've got an inflation spike risk and perhaps a strong US dollar, which destabilizes emerging markets in general. Strong dollar is never any good for emerging markets. Got the e-commerce risk for retail. We've got perhaps on the fiscal side, the EU funding is used as a punishment for populism. In Hungary, for example, Mr. Orban and the EU have been at each other for years. Now we're seeing the same here in Poland between the PiS government and the EU. So that may be something that's used as a weapon. That's the only weapon that Brussels has in its hands to deal with populist governments, is EU funding. Taxation risk, I call it the Trump Brexit world. In my piece of research, I wrote it as Trumpism, even though we haven't got any evidence yet that of what actually Mr. Trump's going to do. But let's call it Trumpism for now. Taxation risk, what we're talking about there is really that the governments are realizing that they have to start taxing capital instead of taxing workers, so taxing their salaries. So this shift is quite profound. We're seeing it manifest in various places, as I said, in Hungary already in the past. And it's something that is there, and there's also something that is certainly now affecting the real estate sector here and elsewhere. And then just finally, global risks. I mean, there's Trump's unpredictability. We don't quite know what he's going to do, particularly on the trade side. That if he disrupts the trade picture with China, that's quite significant. Within China itself, debt instability. China's debt to GDP is 270% overall, which is just crazy. It's been building for a decade and a half. This is a big risk out there. And I think that that's actually one risk that we have to watch very closely, and that will affect all risk assets across all asset classes if it does unfold. So that's something we also have to watch. That's all I wanted to say. Thank you very much for your time.